Welcome to Risk Watch. I'm Jonathan Ferguson. The CFPB recently released a report highlighting the rise in the number of longer-term auto loans, meaning loans with terms of 6 years or more. Many industry experts think that this report could mean increased regulatory scrutiny of longer-term auto loans. Carolyn Orner of AffirmX is here with details from the report and tips to help you stay out of trouble if regulatory attention heads in that direction. Carolyn?
Thanks, Jonathan. Over the last decade, there's been a rapidly increasing trend in auto lending in general. However, since 2016, that trend has flipped. On the whole, auto lending to almost all consumers, except those with super prime credit scores, has seen a sharp decline. What's interesting, though, and what causes the CFPB some concern, is that even while auto lending on the whole is declining, there has been an increase in longer-term auto loans in the last several years. A longer-term auto loan, as defined by the CFPB, is a loan with terms of 6 years or more. This chart shows the distribution of loan terms from 2009 to 2017. 6-year loans are represented in blue. In 2009, 26% of auto loans were longer-term loans, but in 2017, that jumped to 42%. The CFPB also found that borrowers' credit scores are closely related to the use of longer-term auto loans. This chart shows the distribution of credit scores by loan term. Borrowers taking out 6-year loans have an average credit score of 674, while borrowers taking out 5-year loans have an average credit score of 713. But credit score isn't the only factor that correlates with longer-term loans. The dollar amount of these loans is also revealing. As you can see, the loan amounts for 6- and 7-year loans are significantly higher than loan amounts for 5-year loans. On average, $20,100 is the loan amount for a 5-year loan, and $25,300 for a 6-year loan. The average for 7-year loans was even higher, at $32,200. So why does all of this concern the CFPB? For starters, most car owners in the U.S. own their cars for about 6.5 years. This means that consumers could potentially be paying off a car that they aren't even driving anymore. Another concern is that consumers who use longer-term loans are buying more expensive cars, making smaller down payments, or financing larger loan amounts. Longer-term loans are attractive to consumers because they significantly reduce monthly payments. But the CFPB notes that this may not actually benefit consumers since financing costs for longer-term loans are much higher. The Bureau's biggest concern, however, is that the movement toward longer-term loans may increase the likelihood of borrower default. This is because riskier borrowers seem to prefer longer-term loans. Ultimately, more longer-term loans increases the likelihood of borrower default, potentially posing greater risks to both borrowers and lenders. A statement like this is a clue that you don't want to ignore, as it strongly hints that supervisory scrutiny for longer-term auto loans may be on the horizon. Prepare now by making sure you appropriately manage and are aware of the risks these loans pose to both you and your customers.
Thanks, Carolyn. For more information about the CFPB's report or to contact Carolyn, please visit riskinbox.com/resources. I'm Jonathan Ferguson for Risk Watch. Thanks for watching.